Hi everyone. So in recent years, an important component part of monetary policy has been the use of quantitative easing. Right, we're going to get a good grip on this right now. Okay, so in its simplest form, quantitative easing is really just about printing currency to increase the money supply. Printing currency to increase the money supply. Nice and straightforward. Let's just understand the mechanism by which this actually works though. Okay, so for instance, the Bank of England will create new money, new currency, and that creation of that money will go to primary dealers, as they're known, or financial service companies, which would include banks and pension funds and insurance houses and so on. So why would they provide that money? Well, it would be in exchange for government debt and government bonds. So the Bank of England is in effect buying government bonds from the financial services companies. Okay, and in return for that, the financial services companies receive that money. Now, what's notable about this, and when it was used, of course, is that it really helps to boost the liquidity of these financial service organisations. So it boosts their liquidity, and at the time when this was first undertaken in the UK and in the US and in other destinations, most recently perhaps by the European Central Bank, as well as in the UK after the Brexit referendum, this then boosts the liquidity of the banking system, and it means that there is an increase in lending to the real economy. So lending can increase, and if you also think about the actual impact of this on a demand and supply diagram, if there is more available money for banks, well, in terms of the actual price that banks can charge for that money because they have an increased supply of it, then it means that interest rates will come down. So we will see lower interest rates in the real economy, in theory. And then, of course, that can help to boost consumption and investment in the real economy here. So we can see that sort of impact taking place perhaps over here. So this would, in theory, help to increase aggregate demand. Okay, that's the simple principle by which this works. It's worth noting that when it comes to this purchase of government bonds, though, we can see that the Bank of England becomes a significant owner of UK government bonds, and this is of course one potential reason why why we shouldn't be too concerned about the size of our fiscal deficit or national debt overall, and that is because the UK's own Bank of England actually owns a lot of that debt themselves. Okay, further to this, it's also worth noting that if you think about bonds and the way the bond market works, imagine a £100 bond in just a hypothetical situation here. Here we might see a interest rate being provided of 2% on a £100 bond for a 10-year period of time. Now, if there's an increase in demand for government bonds, you can see that these primary dealers, the finance houses here, are going to be able to command a higher price for those government bonds. So what may then happen is the price of those bonds, let's say the market went absolutely wild and it doubled to £200 from £100. Now here we can see that they were getting a 2% rate of return, so that would equate to £2 on that £100, but now, well, we're still getting that 2% return, but the 2% was on £100, so it means that actually the interest earned on that bond would come down to just 1%. Okay, so this is interesting to note. You can see that the price goes one way and it goes up and the yield goes down. So if the bond market is quite buoyant, then we can see that returns in the bond market will actually be a lot smaller. Okay, now that is a really technical point. Don't worry too much about that last one, but it's just something that some students may be interested in. Now this does have a repercussion though, because in effect what we can see is lower interest rates here. We can see lower yields on government bonds, And as a direct consequence of this, then it's certainly argued that it can help to really fuel increases in asset prices. And this is where we're getting onto our analytical and evaluative points here. So what sort of impact might such a policy actually have on asset prices? Not so long ago, the Financial Times Stock Exchange of the 100 leading companies, the FTSE 100, reached an all-time high, well in excess of 7,500. Now, that is partly as a consequence of this, and that bondholders no longer get good returns under a system of quantitative easing. So this can have a positive wealth effect, of course, but it also means that property prices will rise, and that may contribute to intergenerational inequality. And it may also fuel up a bubble for further down the line. And certainly a lot of people are concerned about the looseness of this monetary policy that we have had over such a persistently long period of time. Okay, there's also, of course, the impact on real purchasing power, because if consumption and investment are picking up, then we've got that direct increase in the money supply, then we can see that prices will increase as a consequence of demand pull inflation. Yeah, perhaps less risk of fiscal crisis, because the Bank of England holds a lot of those bonds, perhaps. But of course, what we're also seeing is the depreciation, the real value of our money, and that is a direct consequence of this expansionary or inflationary policy. There's also the risk that this could be interpreted by other countries as an effort to actually depreciate your currency. If you're depreciating your currency, they may think very carefully about why you may want to do that. Perhaps it's about improving your net exports. That is the X minus M component within your aggregate demand. And this can then lead to beggar thy neighbour depreciations, where other countries would want to follow a similar pathway. Okay, so there are a number of problems here. Finally, it's just worth noting as well that no one really knows the actual impacts and how this is going to affect the economy, or how it has actually affected the economy since it was first introduced. Further to that, of course, we do not know what sort of longer term implications, what sort of dynamic impacts this may have on the economy as a whole. Okay guys, interesting concept. Thanks a lot.